Here. Actually, it's quite interesting. We hosted our seventh annual M&A conference last week. We had about 300 corporate clients in the building, and we asked them what their expectations are for this year. And the vast majority said they expect more or substantially more M&A this year. And then the second question we asked them in a survey was what the drivers are going to be for activity. And the predominant answers were growth, focus, and CEO confidence. And so that actually is quite consistent with what we see in the dialogue with our clients. There's a lot of focus, in particular in Europe, on re-energizing growth. There's a greater degree of confidence that comes with a shift in sentiment. And when you look at the data, actually, M&A is up almost 20% in the 500 million to 10 billion value segment versus last year, and up almost 50 versus 2 years ago.
Monetary policy was one area cited where there's been some uncertainty, and that looks to be getting clearer. But I find that extraordinary because when it comes to the United States, we're yet to see what Powell's response will be to Trump's policy actions. In Europe, the ECB already recalibrating to an extent where, as it was looking at declining growth, now concerned that it's going to have to pull back because we've got big spending packages. So what sort of monetary policy clarity are we really getting that enables M&A to happen?
I think it's all relative. When we came out of 2021, 22, 23, monetary policy moved at a pace that was almost unprecedented in the last century. And so at this point in time, I think we're talking about adjustments in monetary policy relative to growth outlooks, which are moderating in the US a little bit, which are picking up in Europe. But by and large, it's still, I would characterize it as a reasonably predictable environment for deal making.
Andre, I hate to be, well, no, I'll play my role as a journalist and be sceptical. I am sceptical because I see the point that Karen just raised there, higher financing costs than many would have hoped for, than many expected. Two, the policy uncertainty, which means that cross-border is a really tricky place to be for big corporates, especially American corporates who are trying to work out where to spend their excess dollars. And three, lower equity markets as well. You cannot use that equity portion so well as you might have been able to do when your stock was 10, 20% higher as well. Those are my major reasons for being sceptical.
Yeah, those are all good points. And look, on financing costs, higher financing costs clearly have an impact. The bigger factor really is more uncertainty about financing costs. And so back to the prior question, I think we're in a place where we have sufficient certainty. There's a little bit more uncertainty in the equity markets for sure. Some of the policy changes that are evolving have had corporates and investors question some of the ways stocks were priced coming into the year. But at this moment in time, we see this mostly as a repricing of equity markets and expectations rather than a change in financial conditions.
I mean,